Okay, so now that we're done with forwards and futures, we can move on to options, which are, of course, the most complicated and sophisticated of all the derivative securities. And so this is where the math really starts to get involved. So we're going to start with section 5, and we'll essentially be using or referring to options throughout pretty much the rest of the course. So we'll start with options. We'll explain what they are, how they work, what are they used for. What really separates options from the others is that if you remember with the forward contract, you're not really paying a price for it. You're just literally entering into an agreement to do something in the future. Even if there's some minor transactions costs, it's not a true price in the sense that you're not actually buying a contract. The same thing is true of the futures contracts. Even though you have to put money into a margin account, it's just a deposit of collateral. It's still your money. And unless you lose it, you'll get to have it back at the end when the contract expires, or you choose to offset it. This is different now. An option is actually a security that you have to pay for. And there's a reason for that, because unlike the other two securities that we looked at earlier, here, while you have the right to lock in the price at which you can buy or sell something, you have the right to change your mind, and that's unusual. The other two are legally binding contracts. This one it's a contract in effect, but it built right into the contract. It clearly shows that you have the ability to buy the asset or sell it if you want, but you're never required to do so. And that's where the power comes from. That's also where the complexity comes from. And this is what we're paying for when we buy an option. So think of it as a forward contract where you can change your mind. That's essentially what it is. So an option is a derivative security that gives the right to buy or sell an option, or sorry, an asset in the future, but no obligation. So in order to characterize an option, we need to look at a few things. Number one, we want to know what the option gives us the right to buy or sell. Whatever it is, that is known as the underlying asset. Now, there's a lot of things that we can buy or sell with an option. The list is very, very long. In fact, it's almost only restricted by our imaginations. So you can see that options are available on a lot of assets, even things that are not strictly speaking assets like interest rates. We also have currencies. We have equities. In other words, you can buy an option on an individual stock, but you can also buy an option on an equity index like the Standard & Poor's 500 or the Dow Jones. Sometimes that's the way to go if you're not sure what stocks might go up or down, but you're betting on the entire market as a whole. That might be your best choice. Then we also have precious metals like gold, silver, platinum, etc. And then, interestingly enough, as you can see in the bottom here, you can also buy an option on a futures contract. So why would you do that? Well, what's actually happening there is that you're actually buying the right to enter into a futures contract with a specific price. Okay, so in other words, an option on a futures contract, which by the way is known as a futures option, provides the owner with the right to enter into a futures contract. And now you would be the one who specifies if you want to be the buyer or the seller. You could do either one at a predetermined futures price. Okay, so notice you have the right to enter into one of these futures contracts, either as the long or the short, but with a price that's been determined in advance. So in other words, once you enter into that futures contract, then your position is the same as if you had bought the futures contract in the first place. At that time, you can hang on to it, you can use it to buy or sell the asset, or you can simply unwind it and then collect your profits, hopefully, if there are any. So now this is an important idea because at this point in time, most options in the marketplace are actually futures contract futures options rather. All right. And that's because it removes the risk that you might actually have to buy or sell the underlying security. In most of these cases, we're not actually interested in buying or selling the asset itself. We're only interested in hedging our risk, and if we make any profits collecting them. We don't really necessarily want to get involved with, let's say, buying gold or buying stocks or whatever. we're really just trying to hedge our risks and or speculate and collect our profits. So futures options are very convenient, but only as long as the futures contracts exist for that particular asset. So as with the example of stocks, there are no futures contracts available on individual stocks. So all options on individual stocks or equity options give the right, but not the obligation to buy or sell an individual stock. On the other hand, futures contracts are readily available on the major stock market indices. And of course, probably know some of their names, such as the Dow Jones Industrial Average, the Standard and Poor's 500, maybe the Nasdaq. All of these have futures contracts available written on them. And so that means that if I want to take on exposure to the overall market without choosing individual stocks, the best bet is to enter into one of these futures options where the underlying asset is one of these indices. So that way, I'm essentially placing a bet on the entire market rather than individual stocks. So therefore, options on equity indices will take the form of futures options. Now, in some cases, it can go either way. There are options on gold, for example, and options on gold futures. They're both available. The individual investor has to decide which one makes the most sense or meets his or her needs more closely. If you're really mean to buy the gold, you can just buy the option right on the gold because at some point that will become necessary. Or if you mean to sell the gold, an option on the gold is fine because that's essentially what's going to happen. But if not, if you simply want to hedge your risks, you really don't mean to take or buy or sell the gold, then a futures option is certainly the better choice because you'll never be required to actually get involved with delivery of the gold. Okay, so you can see why, for the most part, the majority of the options that are trading in the marketplace are actually futures options because of their convenience. So now what's interesting here too is that unlike forwards and futures, where if you remember forward contracts are negotiated directly between counterparties in the over-the-counter market, as it's called. Futures contracts are only available through organized exchanges such as as we saw earlier, the Chicago Mercantile Exchange, although it's not the only one. It certainly is the biggest in the United States, possibly the world. It's big. The volume of trading there is quite large. And so in fact, futures trading originated in Chicago because originally all futures contracts were written on agricultural products, corn, wheat, hogs, pork belly, whatever. And that's where most of that trading took place in the 19th century. So it stood to reason that when futures contracts were created, that the exchanges would be located in Chicago rather than New York. Now, of course, you can buy these contracts in almost anything, but originally derivatives were only available on agricultural commodities. But anyway, futures contracts were only available. So some options are negotiated directly with counterparties in the over-the-counter market, which is often abbreviated OTC, by the way. If you've ever seen those letters, that's what it refers to. And some are available through organized exchanges. So in other words, it can go either way. Now, typically though, normally what happens here is that options written on heavily traded assets, such as futures contracts, currencies, gold, interest rates, whatever it is, are normally bought or sold through exchanges. And options written on other types of assets that are not as heavily traded. For example, options on industrial metals, such as zinc, where there may not be a futures contract, are negotiated in the over-the-counter market. So you can find either one. I mean, it depends what you want, but the bottom line is you can essentially have an option on almost anything you can imagine. If it's something fairly common, like currencies or gold or silver, you'll probably find it in the exchanges. If it's something more obscure, you'll probably have to negotiate it directly with a counterparty. Or another good example, this would be currencies of relatively small countries. Like, for example, how about Iceland? Okay, the Icelandic kroner does not trade that much in the world markets. It's a small country. If you do business in Iceland, though, and you need an option, you're not likely to find it on an exchange. Probably you'll have to go negotiate it directly with an Icelandic bank, let's say. But it's doable. It's very doable, but it has to be done in that market. You won't find it on the CME, let's say. Okay. All right. Anyway, so that is one of the interesting features of options, the fact that they're available in these two different ways, over the counter or through exchanges. Now, because of that, though, sometimes you find options in this over-the-counter market on things that are nothing to do with financial assets. Like, for example, it's actually possible to negotiate an option on the temperature. Why in the world would you do that? Well, imagine yourself running a ski resort, and the thing that worries you is that it'll be too warm that winter and you won't get any business. So you can actually buy an option on the temperature and set it up so that you get a payoff of some kind if the temperature is too warm. And that helps protect you against losses in your business. And similarly, we can get options on rainfall and snowfall, depending on what kind of business you're in. You may want protection against too much rain or not enough rain, or too much snow, not enough snow. But this has to be done in the over-the-counter markets because you're not going to find this trading in organized exchanges. All right, but it's good to know that they're out there if you need them. Now, the strike or exercise price is the price at which you're allowed to buy or sell the underlying asset. Now, remember, with forward contracts, the price was called the forward or delivery price. With the futures contract, the price was the futures price, but here it's called a strike or exercise price. Then the maturity. Now, all financial derivatives or all derivatives have some maturity date. They don't last forever. Unlike a stock, which does in principle last forever or until the corporation goes out of business, an option, future, forward, they all have a specific time until they expire or mature. And after that, they're worthless. So you've got a fixed length of time in which to decide, do I want to exercise it or not? Do I want to buy the underlying security? Do I want to sell? Or do I want to just let it expire if its value is too low? And then now, by the way, most options have maturities of less than a year, although there are some that go out further than that. Now, here's another way in which the naming conventions are a little bit different. Calls are the options that give you the right to buy something, and puts are the ones that give you the right to sell something. All right, you got to remember that terminology. Call is the right to buy, put is the right to sell. And then finally, most options fall into one of these two categories. They're either European style, which means you have to wait till the expiration date to decide if you should exercise or not, which means you either buy the asset you have the right to buy or sell the asset you have the right to sell. The American style options, you can decide any day if you want to exercise it or not. Now, of course, that means that the American style options are more valuable, but it also means they're more expensive. Now, just for the fun of it, what I'm going to do is show you a chart of actual options that would have been trading on Friday, finance.yahoo.com, which is a good place for financial news and especially data. They have a lot of good data here. Let's say I'm interested in an Apple option. And because I'm interested in maybe speculating in the future direction of Apple stock. So I use the ticker symbol to get first to the prices. Okay, it seems to be just so. Oh, here it is. Here it is. And then you come down here on the side. This is, by the way, if you missed that, finance.yahoo.com. If you've never used this website, I'll put this down here. A good source of financial data that we use. It's finance.yahoo.com. Right. Anyway, but you know that if you're looking at stocks, it's really more focused on stocks than anything else. But um, let's say I'm interested in Apple options. If you come over here to the left, you can see that it says options. And what's going to happen is it'll show me a chart of all the options that were available on Friday. So we start by looking in the upper left-hand corner. This is the maturity date. Now, the ones you're seeing here, all expire on Friday the 8th. That means I have until Friday the 8th to decide if I should exercise them or not, because I'm equity options, particularly American stock. And then, oh, what happened here? All right, let's try that again. Options, please. Oh my God, what's happening? Oh, here they are. Okay. But if you see here, there's a lot of them to choose from. They go up a ways, but the trading volume in the later dates is going to be very, very minimal. Okay. It may not be a smart move to buy one that expires so far in the future. It's being very stubborn today, I can tell. I don't know why. It's anyway, so here the calls are listed on the top, the puts are listed on the bottom. The important detail here is this, the strike price. Okay, now the stock, well, it looks like they're updating this a bit, is around 202. So this first option on the top has a strike price of 110, which means if I own this call option with a strike of 110, I have the right to buy the stock for $110, which is nice because the price is only, I mean, it's 202, but the price that I would pay for it, the ask price is 93.20. Look at that. So that's going to cost me a fortune because it's worth a fortune. And then if I raise the strike prices, the price that I have to pay keeps going down. And as you can see, once I hit, let's say 202.5, the price of that option is only $3.60. So what I'm paying for is the possibility that the Apple stock could go up between now and next Friday and provide me with a profit. Okay. So if I buy that one, and the stock price is only at 202.38, it doesn't have to go up very much for me to start making money. So, but if I keep going down, there's some down here that if I'm really optimistic, look how low these prices are. Look at this at 250. It's only a penny. But the stock would have to go over $250 for me to make some money. So that's why it's only selling for a penny. Then when we come down here with the puts, it works the other way around. This put with a strike of 110 gives me the right to sell it for 110, which I would never do in a million years. So the value is a penny. The prices of these options are very rarely at zero because there's always a slim chance that they could still be profitable. So normally the minimum price is a penny. Okay. Um, but then as the price goes up, let's say to 220, that's pretty valuable. I can sell the stock for 220 when it's only worth 202.50, but then I have to pay $18.10 for it. And you can see, wow, look at this one, 305. I could sell it for 305, more than $100 above the stock price, but that's going to cost me 103.20. So I have to choose which one of these makes the most sense for my situation. Also, I have to make up my mind if I think the price is heading up or down. If I think the price is headed up, I'll buy a call. If the price is going down, or if I think it is, I'll buy a put. Okay. Um, so that, yeah, so right now it's not, by the way, I just want to mention here, it's easy to find stock prices on the internet. Option prices are much more challenging because you normally have to pay for them. They're very valuable to say the least. Anyway, so let's get back to this real fast. And then the premium. We just saw a bunch of options with their respective premium. And so, as I mentioned earlier, what really separates options from the others, the forwards and futures, is the fact that you must pay a premium or a price to buy an option. What you're paying for is the possibility that the value will go up in the future. And what's really important about options is that you can never lose more money than you paid for the option, but there's no limit to how much money you can make. Okay, so there's an imbalance there between potential losses and potential gains. That's not the case with futures contracts. With a futures contract, you're only putting a small amount of margin into an account. If things go wrong, you could end up losing many, many times the original margin account balance. So here, though, you're limited in losses to how much you paid for the option, but there's never going to be any upside limit how much you can make. That's kind of nice. That's another thing that you're paying for when you buy an option, by the way. So options are levered in the sense that it doesn't take much. Let's say you own an option on gold. Depending on which one you bought, a 10% change in the price of gold could actually have like maybe a 50% change in the value of your option, depending on which one you bought. So in other words, we call them leveraged in the sense that there's a lot more risk. The gains and losses are magnified compared to owning the actual gold itself, which means that this is a great way to speculate on the future direction of prices in the market. And I think I mentioned this earlier, the discussion we had about short selling a stock. Um, Short selling a stock is a major nuisance, but until options came along, um, the only way you could speculate on stock prices going down would be to short sell. So before options became available in the United States, short selling a stock was the only way to speculate on the price dropping. Now, an investor who believes that a stock price will fall can simply buy a put and will profit. Stock actually falls. Now, short selling, I don't know if I mentioned this earlier, but with short selling, you can lose more money than you started out with. You can really get clobbered if you're not careful. Here, again, you're limited to your losses are limited potentially to how much you paid for that option. So puts are a very simple and direct way to speculate on the price of the stock going down, whereas calls are a very simple and direct way to speculate on the price going up, with the additional benefit of being leveraged. So I could have, if I set up myself correctly, it could be that even a 1% change in the price of the stock could add 10, 15, 20, 30% to the value of my position, but it goes both ways. I could also lose that much with the understanding that the maximum loss is what I started out with. All right. Yes. So a 10% increase in the price of gold in principle could add 200% to the value of my position, but I can't lose more than 100%. So we're going to introduce a very important concept, the notion of the payoff. So in order to make this more easily to understand, I'm going to start out with an example of how a payoff works. So let's say, for example, an investor buys a call option with a strike price of 3,500 per ounce. And let's say, just for simplicity, that the spot price of the gold, the price in the marketplace, is also 3,500 per ounce. The option expires September 1st. And costs, let's say, $100. Fine. All right. So now, an investor buy call for one of two reasons. If one expects the price of the underlying asset to rise above the strike price, or number two, he is hedging the risk that the price of the underlying asset will rise above the strike price. So in other words, it could be either one. Okay. Now, let's assume that September 1st rolls around. We're going to look at two scenarios. Scenario one, the gold price rises. Okay. So on September 1st, let's assume the price of gold has risen to 3,700. But now the investor who bought this option is quite happy right now because look at what they have the right to do. The investor can exercise the option, as it's called, to buy gold at 3,500 per ounce, and then immediately resell it in the market for 3,700. This is referred to as a payoff of 3,700 minus 3,500, which is 200. Okay, so we were able to take buy the gold for 3,500 when it was really worth 3,700. That means we have a payoff rather of 200, but the profit is only 100. We have to pay $100 that option. But still, we just doubled our money because we went from 100 to 200. All right. So, and the investor has earned a 100% profit, even though the gold price only went up. How much was that? 200 out of 3,500. That's not much. 5.7%. Look at that. And that turned us into 100% profit. We paid 100, now we have 200. That means we doubled our money. Look at that. It didn't take much. So we have a payoff here and we have a profit. We need to keep track of the distinction between the two. And now, on the other hand, here, scenario two, on the other hand, the sad one, the gold price falls. So let's say in this scenario on September 1st, assume that the price of gold has fallen. Let's say to 3,300 per ounce. The investor will not exercise the option to buy gold at 3,500 per ounce, since it is only selling for 3,300. Okay, so the option expires and the payoff is because it's not being used. The profit, on the other hand, is actually a loss of $100 or 100%. And again, it didn't have to fall very much because already the price was 35. If it fell anywhere below that, we were going to lose our entire investment. So now you can see also here the difference between the call option and having a long forward position. The main difference between having call option position is that in the second scenario, the investor does not have the hold and is therefore able to maximize its losses at the price paid for the option. So you see, remember before the long forward position, we would have been forced to buy the gold at 3,500, even though it's only selling for 33. Here, that's not the case. We have the right to say, no, we're not going to do this. And therefore, the maximum loss is always going to be the amount you paid for it. And on top of that, the lowest possible payoff is zero. It can't be negative. The payoff to an option can never. That's an important step. Okay. Now, what we're going to do is I will actually summarize this with some algebra. It's going to be written like this. S is the spot price of the asset. X is the strike price of the option. Max, of course, means maximum. And so what's happening here is that if S is greater than X, the payoff equals the difference between the two, which we know is positive. Otherwise, the payoff is simply zero. And so therefore, it's got to be the greater of S minus X if it's positive or zero. And that's why it's written this way. Now, there's other ways we could have written it, like as a piecewise function, that kind of thing. But this is the normal way that we express this. And then the profits would simply take that payoff and we subtract the cost of the call. Okay. So payoff is how much we actually put in our pockets as a result of this transaction. The profit takes into account the cost of the option. Okay. Now, you're probably wondering, well, this is very interesting. It turns out that with options, there's a set of graphs that we can use to help us visualize what's going on here very quickly and easily. And it looks something like this. If I'm plotting dollars, meaning the profit or the payoff, against the spot price of the asset, so I can never lose more than C dollars. Here's the strike price. This box is the maximum loss. It's going to be thought of as my break-even point. Which means that's where the payoff is exactly the same as the cost of the option. After that, it's all profit. And if you notice too, the slope of this curve that we're describing here is zero up until we reach X. After that, it's equal to one because every $1 increase in the asset price adds $1 to the payoff. Interesting. And you'll see we can use these graphs to create lots of interesting payoff profiles, they're called, which means we can explain how different strategies would work where we combine positions in different options, which is a common thing to do for options traders. Instead of just buying a single call or a put, what they'll often do is combine different positions to come up with these much more complicated strategies that you'd be surprised how complicated they can get. Um, so anyway, that is our call option. What about the put? Now, the put is the one that lets us sell, which implies that everything must be working in reverse. By the way, the examples, so this is the same. Oh, here's some terminology you need to be comfortable with. It's not such a big deal, but if the spot price exceeds the strike, which means we would exercise the option, we say the option is in the money. Okay. Meaning that it's right now, if we exercise the option, we have a positive payoff. If the two are equal, we say that the option is at the money. And if this is less than X, which means we're not going to exercise it, we say that the option is out of the money. All right. Now, there's some examples in here involving IBM stuff, but they're pretty much exactly the same as what we've been doing. So we'll skip ahead a little bit here. And consider the put option. Remember, this is the one that gives you the right to sell. It's equivalent to the short forward contract, except there you do have to follow through. Whereas with the put, you can walk away from the whole thing. Okay, now, because you have the right to sell, the payoff per put is max X minus S and 0. Okay, so in other words, we've reversed the roles of the X and the S. And you can see what's happening here. If that's false, X minus S rises and the payoff increases. Or if you were to differentiate this function with respect to S, you would get a negative 1. So we reverse the two, but you still have to pay for this thing. So the profit will be the max X minus S and 0 minus P, where P is the put price. Okay. So, I mean, we could go through another example, but I think it's pretty clear that with the put, you would be exercising the put in scenario 2 rather than 1. Okay. In fact, if you want, what we can do is just copy these and make the changes. It won't take but a minute because we're just reversing everything. So here, the investor will not exercise the option because they have the right to sell it for 3,500. So you're not going to sell it for 3,500 when you it's out there being you could sell it for 3,700. Okay. Actually, I think I should include this part too. Hold on a sec. That might help. So you know what's going on. So this time the investor buys a put. All the other details are the same. An investor will buy a put if he expects the price of the underlying asset to fall below, because you're speculating on the price falling, or he's hedging the risk that the price of the asset will fall below. Either way, you'll get a profit, and that will help offset any losses you might suffer in the spot market. Okay, here we go. All right, now it makes sense. All right, so in scenario one, um, the payoff is zero. The profit is zero minus 100, because remember, we paid that much for the put. A loss of 100%, but that's as bad as it can get. Scenario two is the opposite. The investor will exercise the put because which is the right to sell the gold for 3,500 an ounce. Um, after buying it in the market for 3,300. So you got in the market, you buy the gold for 33, you use your put to sell it for 3,500, and you have a payoff of 200. The profit is 200 minus 100, which means, again, you doubled your money. The investor doubled his or her money in spite of a fall in price of gold. This time it would be, oh, actually, no, it would be the same. It's 200, it's 5.7%. So not bad. If they own the gold, well, I mean, okay, it's not nearly as, so that's what we mean by leverage, okay? All right, so that being the case, then you can see why the logic behind these statements here. The payoff is max X minus S in zero, and the profit or loss is max X minus S or zero minus P. Okay. So then the graph looks like this. Okay. Now I do want to mention there is one way in which and by the way, if you look at these side by side, you'll see, let me see if I can show them both together at once. Uh, I just want you to be able to visually see how they're related to each other. You're just flipping it from left to right. Okay, it's the same thing reversed from left to right. So in other words, one is a mirror image of the other. The only key difference here, though, between the two, with the call, there's literally no maximum profit. This line could go up forever. Over here, though, there is a maximum profit because the gold price rather, can never be negative. So there is a maximum, but it's very, very high, to say the least. Okay. So that's one way in which the symmetry breaks down. All right. By the way, these obviously have to be changed. Now, when the gold price is below the strike, the put is in the money because we'll exercise it and have a positive payoff. When X equals S, this part is the same. They're both at the money. And when X is below S, we're out of the money because we would never exercise the put if the gold price was greater than the strike price. That would be scenario one. All right. So again, they have an example of IBM stock. You can look at that later on if you want, but it's very similar to what we're doing. Instead, um, Now, here's what we have to think about, though. This is something we've kind of neglected up to this point. In order for there to be a buyer, there has to be a seller. Like with the forward contracts, remember, there's a long and a short. Same thing with futures contracts. That has to be true here too. Whether we're dealing with the over-the-counter market or we're going through the exchanges like the CME, the seller of an option, all also referred to as the writer, has the exact opposite payoff profit loss as the buyer, in the sense that between the buyer and the seller, the total profit is zero. It has to be. They can't both make money because they're on opposite sides of the same position. So what that means then is that we have to define a new payoff profile and a new profit or loss function for the sellers. Now, as I mentioned before, sometimes traders will actually take long and short positions in these options. So it's not like these are a separate category of investors in the market. The same trader, the same investor, the same market participants can both buy and sell. So buying and selling are the opposite. And so for the sellers, for call, the call payoff is it's just a negative of the call payoff to the buyer. Every dollar that I make as a buyer in my payoff is a dollar lost to the seller. If I'm able to buy the gold at an advantageous price, who am I buying it from? The seller. That means they're at a disadvantage. But then in exchange for this, the seller is collecting the premium. So the call profit looks like this. So in a way, it's kind of like the position of an insurance company because they collect your premiums, and the best thing that can happen to them is that nobody ever has an accident. If they do, they have to give you a pretty hefty payout. So it's kind of the same thing here. As long as nobody exercises those options, the sellers can do very well. But once they do, they can lose a lot of money. And in fact, when you think about it, if the buyer of a call has limited loss potential and unlimited profit potential, what does it say about the seller? Seller of the call has an unlimited loss potential and a limited profit potential. Not a sweet position to be in. So let's take a look at what the graph looks like now. Actually, this one, I'm going to have to draw it a little bit differently. Uh-oh, what hurt? So that's call seller's profits. And what happened was it took the call buyer's profits and flipped it upside down. Okay, it's just literally upside down. And guess what? There's no maximum loss. Put an exclamation point there to drive that point home. Wow, that's terrifying. But normally, when investors or traders are selling these options, they also have bought other options so that the risk is limited. You wouldn't normally see somebody just simply sell a call and let it go at that because it would be a terribly risky thing to do. We also have to consider the position of the put seller. And then all four of our basic positions will be in place. So the payoff is the negative of that of the buyer, negative max, x minus s and 0. And the profit, though, reflects the fact that they collect their premium. Okay. So just like before, the two of them are on opposite sides of the same situation. One makes money, the other has to lose the same amount of money. And that's what we're seeing here. Now, the graph, let's take a look at this graph. All right. Hold on one second. My tablet is being uncooperative right now. Okay, so it's the upside down. We took the position of the put buyer, flipped it upside down, and this is what it looks like. But again, here you notice there is, in principle, a maximum loss, but it's a terrible maximum loss. It's really bad. Actually, this should have been me. Okay. Actually, I think I may have done the same thing with the other one. Hold on one second. No. There isn't one. That's right. Okay. So those are the positions, the basic positions: call buyers, call sellers, put buyers, put uh, sellers. And so we summarized all these. Now, as I mentioned before, there's some very interesting strategies that we can create with these four basic positions. And many of them fall into one of these two categories. We have spreads and we have combinations. Spreads consist of um, positions in two or more calls or two or more puts. Now we're going to get involved with multiple calls or puts. They have to be different in some important ways. So usually the options spread have exercise or strike prices. Mostly they have the same asset and trading. If they don't, then it's a different position than the one we're looking at here. Then it has a completely different name and it works differently. But when we have a spread like this, we're basically combining calls and puts. Calls or puts. We never mix them together here. And if there's multiple calls or puts, they have to be different in some way. And that way is that they usually have different strike prices. Sometimes we buy one and sell the other. Sometimes we buy them both. Sometimes we sell them both. It depends on what we're doing. But the bottom line is it's two or more calls, two or more puts. And normally the way they differ from each other is they'll typically have different strike prices. And you'd be surprised some of the things that are possible with these positions. And then we have combinations. Now, by the way, this is just the tip of the iceberg. There's plenty of other strategies. These are some of the more basic ones. Consist of at least one call and at least a put. Okay, so you got to have some of each to make it a combination. Because they're different types of options, they may have the same strike price. but not. So usually, they will have the same underlying asset, and trading. So, we'll start with our spreads. Now, these are the three you want to consider. And, we also, whenever we look at a strategy like this, we want to ask ourselves, why are we doing this? What do we hope to accomplish? So the bull spread, by the way, if you don't know, bullish on Wall Street means optimistic about a stock or other asset. It doesn't have to be a stock, but I mean, it means you're happy about something. You think something's going to go well. Okay, it means to be optimistic about a position. And of course, the opposite is bearish. So notice this is the reason why it's called this. Now, a bull spread is constructed by buying a call. Oh, I almost forgot to mention this. Um, a bull spread that is constructed with two puts, sorry, two calls, is known, as you can probably imagine, a bull call spread. Just so you know which one it is. So therefore, obviously, a bull spread that is constructed with two puts must be known as a bull put spread. So let's assume that we're looking at a bull call spread. A call, buying a call with a low strike price, and then selling a call with a high strike price. Both have the same maturity, as we so often see in underlying asset. What is that going to get us? Well, this is a relatively, as we'll see from the graph, inexpensive way to benefit from a rising asset price, but at a lower cost than simply buying. So it's a little bit cheaper. The only drawback, though, is that the upside potential is limited. So that's where you're giving up. I mean, in order to lower the price, you have to give up some of the upside potential. So you wouldn't do this unless this means you're really cautiously optimistic about this asset. Now, what I'd like to do is show you the graph in here. Now, this graph is based on IBM stock, but the logic is the same as what we had with gold. So let's skip ahead to the diagram that shows the profits and losses. So, for example, suppose that equal spread is set up by buying a call on IBM stock, the strike price of 50, selling a call on IBM stock, the strike price of 53, both mature on September 1st. The profit and loss diagram and here it is. So take a quick look at it. It's going to take a minute because the graph is very space intensive. All right, let me see if I can straighten that out a bit. Yeah, it doesn't No, okay, that's not so bad. I mean, it's not ideal, but you see, the blue tells me the where my profits are, and so you can see that there's a maximum loss of $1. There's also a maximum profit of $2. You don't get that if you own just the call. I could have just bought the 50 strike call in the first place for $3, but that means it costs three times as much, but then I keep all the upside potential here. I'm basically saying that I don't expect the price to go much above 53. Otherwise, I wouldn't be bothering with this. So it's a cheaper alternative. It's being very stubborn with me right now. Hold on a second. Whenever it gets like this, I always try to make sure that I've saved it properly. Otherwise, I'll just lose all my work and I won't like that. But right now, it's not letting me type anything. There we go. All right. This is a cheaper alternative. Simply buying 50 strike call at $3. The cost of the position has been reduced by 2/3, but the limited to $2. So therefore, you would never do this if you really thought it might go to 55 or 60 or 80 or whatever. Um, but if you think it's going to go up just a little bit, well, then this might be the position for you as a trader. But the important thing is that it is a spread. It has two calls. Now, by the way, we could have done the exact same thing with two puts. And it isn't, we're optimistic about the stock, but not very optimistic. And so this is what we've set up. It's called a bull spread because we're basically betting on the stock price going up. Okay. So now there's a few others that we'd like to do. There's some of these in here that you will be very surprised by what is possible with these options. So we don't want to spend too much more time with this. What it, yeah, all right. Well, we'll get back to these very soon in the next session. But after this is done, what's coming up next is our first look at the actual pricing of options with the so-called Black-Scholes model in section 6. And that's where it starts getting very quantitative. Yeah, this is an interesting model. There's a lot of statistics, there's a lot of math, but this actually was the breakthrough that made it possible for options to trade in the United States. So this is a huge deal. Anyway, so what we're going to do is a couple of things. Finish up strategies. There's not too many more. Introduce Black-Scholes model, which, by the way, only was published in 1973. Prior to that, options couldn't really be traded because nobody was really sure what they were worth. It proved to be a very complex problem that was solved by these researchers who eventually won the Nobel Prize in economics. That's how important this proved to be. It's almost like relativity in physics. It's that important. And so when we do that, we'll actually show how it works in Excel. And then what we're going to actually do is take a bit of a detour, introduce VBA, which is the Visual Basic for Applications language that is built into Excel, and see how code can be written to implement the Black-Scholes. And once that's done, then we can actually have a couple of assignments, which I've been waiting for, um, where you will be able to take some other option, let's say, and write code for it based on what we're going to do. So the slides do have all the instructions that you need. Plus, I'll send you copies of the code that we're going to use here. So that way, it's not like you've got 2 weeks to learn a brand new language. It'll just be a case of learning how the grammar works and how to implement it, how to go into Excel and, use the editor and just do some basic coding to come up with, prices for different types of options, let's say. And so that way you can learn some basic coding, you see how this VBA language works, you'll learn more about option pricing, because it's this part of the course where that lends itself very well to numerical analysis. And so this is where it's going to get very intense, but also very interesting. And then what's going to happen is we're going to look at more complex models and alternative approaches to pricing options, including something called Monte Carlo simulation, which involves a certain amount of statistics. But you'll see that each approach to pricing options has its own strengths and weaknesses. And so we're going to learn how to implement them in VBA and in Excel, of course. And so that's what's going to come up in the next several sessions. All right. So in the meantime, I think we'll stop right here. And then next time we meet, we'll wrap this up. We'll do some Black-Scholes analysis using our Excel examples, and then I'll finally show you the secrets of VBA and how to use it. All right, good. So we got a lot to look forward to, and I'll see you next time.